If you only watched the Nasdaq this week, you saw a market in trouble. If you only watched the Dow, you saw one at record highs. Same 5 days, same economy, and you'd hardly know it was the same market. This was the week Wall Street split down the middle. And figuring out which half is telling the truth is the whole game. Start with the scoreboard, because the gap is the story. For the week, the Nasdaq fell 4.6%, closing at 25,298, its fifth straight losing session by Friday. The S&P 500 lost nearly 2% to 7,354, and the Dow, it rose 0.6% to 51,876, touching a fresh record high along the way. When one major index has its worst week in months and another is printing records, the selling isn't everywhere. It's targeted. And this week it was aimed squarely at the trade that's carried this market all year, artificial intelligence and the chips underneath it. The damage started overseas. On Tuesday, a global semiconductor rout tore through Asia. South Korea's KOSPI fell almost 10% and tripped its circuit breakers, with memory giants SK Hynix and Samsung down more than 12% each. It rolled straight into U.S. trading. The Nasdaq dropped more than 2% that day alone. Micron fell 13%. SanDisk, 13%. Intel, Qualcomm, and AMD all sank. The big chip ETF lost 7% in a single session. Underneath the price action was a colder question: who's paying for all this AI? The hyperscalers are funding their data center buildouts with debt. SpaceX, fresh off its public debut, tapped the bond market, and its stock slid below where it opened on day one. Then came the report that OpenAI is weighing a delay to its own public offering into next year, partly because SpaceX's rough landing spooked the market. The thread tying it together, the AI trade runs on capital, and for the first time this year, investors started asking whether the capital keeps showing up. But here's what the scary headlines missed. The money didn't leave the market. It moved. While tech bled, investors rotated into the parts of the market that had been left behind: consumer staples, healthcare, industrials, financials. Walmart, Johnson & Johnson, and Caterpillar all climbed. Small caps held their ground while the mega caps sank. On several of the red days, more stocks rose than fell. That is not what a market crash looks like. It's what a rotation looks like: capital recycling out of the most crowded trade on Wall Street and into everything else. It's the broadening the bulls have been asking for all year. They just didn't expect it to arrive by way of a tech scare. The backdrop made it messier. Oil collapsed this week. Brent and WTI both fell hard as tankers kept moving through the Strait of Hormuz, and the U.S.-Iran peace framework held. Cheaper oil cools inflation, and late in the week, the Fed's preferred inflation gauge came in softer than expected. Both of those should ease the pressure on the Fed, and yet traders spent the week leaning the other way, pricing in a second-rate hike by December under new chair Kevin Warsh, whose hawkish debut still hangs over everything. That's the squeeze: cooling data on one side, a Fed that won't blink on the other. And long-duration growth stocks, the AI names, are exactly what gets hurt when rates stay higher for longer. The sell-off and the macro weren't two stories. They were the same one. So which half of the market is right, the Nasdaq or the Dow? The week didn't settle it, but it left one tell worth watching. Micron reported the single best earnings of the season, a massive beat, a raised forecast, revenue more than quadrupling from a year ago. And the stock got sold anyway. Selling the best possible news is the kind of thing that happens in a healthy shakeout, when expectations were simply too high. It's also the kind of thing that happens near a top. Earnings season ramps back up in July, in a holiday-shortened week, with the June jobs report landing early. A hot number there would pour fuel on the second hike bet. That's when we start to find out which half of this market was right. For now, the weight of the evidence points to rotation, not rupture. The breadth, the record on the Dow, the resilience in everything outside of tech, that's a market repositioning, not unraveling. But Micron is the line in the sand. As long as great news keeps getting sold, the smart move is to respect the rotation and keep one eye on the exits. We cover the markets on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.